Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are really going to dig into three major bottlenecks that are, kind of defining the global economy right now. We've been looking at some recent analyses covering a few critical areas.
That's right.
First, the pretty acute crisis brewing in U.S. energy. Then, the collapse of trust in China's huge property sector. And finally, a really crucial shift in where the money is flowing in the world of AI investment.
And they might seem like totally separate issues, but they're not. There's a common thread here.
What's that?
It's this idea of a structural bottleneck. In all three cases, you have this incredible economic velocity demand, basically, that is just slamming into a wall.
A wall? You mean like a physical one?
Sometimes, like an old power grid that can't handle the new demand. But sometimes it's intangible, like investor confidence just evaporating.
Right.
So our goal today is to really get past the headlines and give you, the learner, a clear view of what's happening under the hood and, turn that understanding into something actionable.
Okay, let's unpack this. And I think we have to start with the literal engine of all of this, electricity. And what some are calling the impending energy cliff. The analyses we've looked at are painting a pretty dramatic picture for the U.S. power grid. It's being described as a genuine perfect storm.
It really is. On one side, you've got this old, aging supply system. It needs massive investment just to keep the lights on as is.
And on the other side?
On the other side, you've got this explosion of new demand. And it's coming from two places at once. You have manufacturing reshoring, bringing industry back to the U.S.
Which is already a huge power draw.
A huge draw. But then, layered on top of that, you have the truly explosive demand from AI, from these massive hyperscale data centers.
And this collision it's just on a scale we haven't seen before.
Exactly. The scale is staggering. According to one analysis, U.S. data center power consumption is set to more than double between now and 2030. More than double. And when you look at the raw numbers, by 2030, those data centers alone are projected to eat up somewhere between 8 and 9% of all electricity generated in the United States.
8 to 9%. Let's try to put that into perspective for a second.
Please.
Imagine 1 out of every 10 electrons generated in the entire country. That single electron is going straight to power what is essentially a digital warehouse.
Yeah.
Just running servers and, maybe more importantly, cooling them.
Yeah, the cooling is a massive part of it.
For decades, we associated that kind of energy use with giant steel mills or aluminum smelters, heavy industry. But now it's the digital world driving it.
And this isn't some far-off theoretical problem. This crisis is already hitting the books. It's a financial reality right now.
How can we see that? Where is it showing up?
You see it vividly in the forward pricing. If you look at the data from the PJM capacity auction for the 2025 to 2026 delivery year, the price just skyrocketed.
Skyrocketed by how much?
Over 800% year over year.
Wow, 800%. Okay, that number is stunning. But for people who don't follow the energy markets every day, help us understand, why is a capacity auction price spike a bigger deal than, say, just a jump in the daily price of electricity?
That's a really important distinction to make. The spot price, the daily price, that reflects what's happening right now. It can be volatile. A heat wave, a plant goes offline, it can jump around.
Okay.
But a capacity auction is different. It's managed by PJM, the biggest grid operator in the U.S., serving 13 states. And it's a forward market.
Meaning it's for the future.
Exactly. This is where power generators commit years in advance to have a certain amount of power available. Whether it gets used or not, it has to be ready to go.
So it's like reserving a hotel room versus just walking in and asking for a room.
That's a great analogy. And what that 800% spike is telling us is that the entire market, the power plants, the utilities, the biggest buyers, they are all looking at the future and collectively screaming, we don't think there will be enough rooms available.
So they're bidding up the price of the reservation just to guarantee they'll have a spot.
You're bidding it up exponentially. The market is pricing in extreme scarcity right now for delivery years from now. It's a huge flashing red light that we're running out of guaranteed future supply.
And that urgency, that flashing red light, it explains what big tech is doing. If you're Google or Microsoft, you can't just sit around and wait for the grid to fix itself.
Not when the market is signaling 5 years of pain and an 800% price spike. You can't. And the analysis points to the biggest bottleneck of all, even bigger than supply itself. It's the interconnection queue.
The what?
The interconnection queue. It's basically the waiting list to connect a new power source to the grid.
So if I build a giant solar farm, I have to get in line to plug it in?
You got it. And that line, to get all the studies and upgrades done now averages 5 years or more.
5 years.
5 years. And if you're Amazon and you're spending tens of billions on AI servers right now, waiting half a decade to power them up
Yeah.
it's a non-starter. You lose billions. Your competitors leapfrog you. The opportunity cost is just too high.
So they're just bypassing the line.
They're using their massive balance sheets to essentially cut the line or build their own line. They're seeking what's called direct connection or co-location.
Meaning they build the power plant right next to the data center.
Right next door. Or they sign these huge contracts for independent power generation. They're literally buying their way out of the grid's constraints.
And some of these deals are just, they're historic. I was looking at the Microsoft deal.
With Constellation, yeah.
They signed a 20-year deal to power their data centers with the output from 3 Mile Island.
3 Mile Island. I mean, think about that. An iconic, previously mothballed nuclear plant is being brought back to life, basically to serve AI.
It just shows you the level of commitment. They need stable 2047 carbon-free power, and they'll go to extraordinary lengths to get it.
They need reliability, and they need power density. Nuclear gives them both. And it's not just about restarting old plants.
No, the other tech giants are looking even further ahead. The analysis shows Amazon and Google are signing deals with developers of small modular reactors, SMRs.
Companies like NuScale Power and Kairos Power. And these aren't just press releases. This is big tech capital that is fundamentally jump-starting the next generation of nuclear technology. They're financing the development of these smaller, decentralized reactors that could be built right next to their future data centers.
This all leads to, I think, our first really critical investment insight here. It's what you could call the energy hedge.
A non-negotiable one.
Right. If your portfolio is full of AI chip stocks, like NVIDIA or AMD, which is the engine of AI,
then the analysis is screaming that you have to hedge that bet. You have to also invest in the fuel tank, the power required to run those chips.
Because the success of one is completely tied to the availability of the other.
You can't separate them. And when you look at the physical needs of these new AI data centers, the infrastructure plays are just enormous.
They're so much denser than old server farms, right? And they run so much hotter.
Exponentially hotter. The chips are packed in tighter. They're drawing way more power per square foot. Your old air conditioning system just can't handle it.
So this is where a whole other group of companies comes in.
Absolutely. This is why companies that provide advanced power management and liquid cooling solutions are just massive beneficiaries. We're talking about names like Eaton, Vertiv, and Schneider Electric.
They're not just selling fans, they're engineering totally new systems.
They're selling the critical life support systems for the entire AI boom. Liquid cooling, sophisticated power distribution units, stuff designed to manage immense heat and power loads. Doesn't matter who makes the best chip if it melts. These companies sell the thing that keeps it from melting.
And beyond that, this nuclear renaissance is no longer a talking point. It's a fully funded, long-term growth theme.
For sure. So investors should be looking at the operators. Companies like Constellation Energy, Vistra, firms that can actually run and expand these plants.
And the whole supply chain behind them.
You can't forget the fuel. Uranium miners like CCJ, they're riding this wave. Uranium is going from this niche commodity to being an essential input for AI infrastructure.
And we have to come back to that off-grid idea, because that 5-year waiting list, the interconnection queue, isn't going away overnight.
It's not. So there's this urgent demand for solutions that just eliminate the need for the central grid altogether. Systems that can generate and store power right where the data center is.
So this is where you see the demand surge for things like solid oxide fuel cells. I'm thinking of a company like Bloom Energy.
Yes, or massive battery storage systems.
Yeah.
These grid-scale batteries, like the Tesla Megapack or the units from Fluence Energy.
And they're not just for backup power, like a diesel generator.
No. They enable true microgrids. They give a data center total power independence, reliability, the ability to manage their own demand without causing a brownout for the whole neighborhood. And the market is paying a huge premium for that kind of independence.
Okay, so let's zoom out a bit and talk geopolitics. Because this energy crunch in the U.S., according to the analysis, it's actually handing a pretty big structural advantage to China.
It is. The data indicates China has a structural power cost advantage. It can be anywhere from 30 to 50% cheaper for big industrial users compared to the U.S.
And that's not because their coal is cheaper or something?
It's not about the fuel. It's about the infrastructure. It's all about their grid. China has been incredibly aggressive in building out this massive ultra-high voltage DC transmission network. UHVDC.
Okay, break that down for us. Why is UHVDC such a game changer?
Well, traditional power lines, which use alternating current, or AC, they lose a lot of power over long distances, like friction.
So the further you send the electricity, the more you lose along the way.
Exactly. But UHVDC loses substantially less.
Yeah.
We're talking only 3 to 5% loss over thousands of miles. It's incredibly efficient.
So China can build a massive solar farm way out in the desert.
In their sunny, empty western regions, yeah. And they can shoot that cheap, clean power all the way to their data-hungry industrial hubs in the east with almost no loss.
And that efficiency is the source of that 30 to 50% cost advantage.
It is. And think about the geopolitical implications. If China can train its huge AI models using power, that's that much cheaper.
Yeah.
That's a massive competitive edge in the global AI race. Faster development, lower costs, it's a huge deal.
Here's where it gets really interesting.
Yeah.
Because this whole power grab is creating some serious political blowback right here at home.
It is. The U.S. Federal Energy Regulatory Commission, or FERC, is
Yeah.
getting involved. They're asking some really tough questions, like whether these exclusive power deals that big tech is signing are going to force electricity rates up for everyone else, for ordinary families and small businesses.
Because if Microsoft buys up the entire output of a power plant,
That power is now off the market. It's gone from the general pool. And if enough big players do this, the remaining supply for everyone else shrinks, and basic economics says the price for what's left goes up.
so you have this collision of two really powerful political forces.
That's the dilemma. On one hand, you have the push for AI development and national competitiveness. On the other, you have the urgent need to control the cost of living for consumers. This is moving from a technical debate in the energy sector to a major political issue.
And it's totally redefining the utility sector as an investment. For years, utilities were, well, they were boring.
Boring defensive stocks, yeah.
Yeah.
You bought them for the dividend, not for growth.
But now all of a sudden they're becoming AI infrastructure growth stocks.
Especially the ones in the right places. Utilities operating in data center hotspots like Virginia, Texas, Arizona. They are seeing guaranteed massive new demand. And because supply is so tight, they can negotiate much higher prices on these long-term power purchase agreements. Their whole profit profile is changing.
So the big takeaway from this whole energy discussion is that this bottleneck is real, it's here now, and it's already being priced in by the market.
For sure. It's going to shape the entire AI investment landscape for the next 3 to 5 years at least.
Yeah.
You have to look beyond just the tech stocks now. You have to be looking at nuclear, at specialized cooling and power management, and at these off-grid solutions to really play this trend correctly.
Okay, so let's shift from a hard physical constraint like energy to something intangible but just as critical. And that is the constraint of trust in the Chinese economy.
Right.
For the last couple of years, everyone's been focused on the obvious problem children, like Evergrande. But the analysis we've seen suggests the real systemic shock, the thing that truly shattered confidence, is the crisis happening right now at Vanke.
Vanke was seen as the last breakwater. That's the term they used.
Why? What made it so different?
It wasn't just another huge developer. It had significant state ownership. The Shenzhen Metro, a key local government body, was a major shareholder.
So the assumption was the government would never let it fail.
That was the operating assumption for the entire market, both in China and internationally, that Vanke was too big and too politically connected to be allowed to default. And that assumption has just evaporated.
And the current crisis centers on a specific bond deadline, right?
A 2 billion RMB bond due on December 15th. And the sources confirm that for the first time in its entire history, Vanke has formally asked for a repayment extension.
Just asking for a delay.
For a state-backed champion like Vanke, that's a 5-alarm fire. It signals that all of their internal funding options are completely exhausted.
And the market is not reacting well.
The reaction has been ice cold. The negotiations with the bondholders, who are big domestic banks and insurers, are reportedly struggling.
Why? What are they demanding?
They're sensing weakness. They're demanding huge amounts of additional collateral to back up the debt. Or, and this is the key part, an explicit, legally binding guarantee from the state-owned shareholder, Shenzhen Metro.
And the government entity is balking.
The analysis suggests they're extremely hesitant. Their own finances are under huge pressure because the property slump means they're not making as much money from land sales. Their reluctance to write a blank check is what has poisoned the whole deal and turned a debt problem into a full-blown crisis of confidence.
You can see that crisis playing out in the ratings and the bond prices.
Instantly. Moody's and Fitch both downgraded Vanke to junk status. But the most chilling number is the trading price of their U.S. dollar bonds. They're trading at around 30 cents on the dollar.
30% of their face value. So the market is essentially saying there's a huge probability of default.
A very high probability. It's pricing in a technical default, followed by a really severe restructuring, where bondholders get, well, not much, a massive haircut.
And this is causing contagion, right? It's not just about Bernanke anymore.
Not at all. The Vanke crisis shatters the core belief that any state-affiliated firm is safe. So now you're seeing panic spread. The bond prices for other supposedly safe state-backed developers, like Poly Developments and China Resources Land, they're all falling. Investors are realizing this is a systemic risk, and they're just pulling out of the entire sector.
So for any investors still holding on, what do they need to understand about the Chinese government's priority right now?
They need to internalize one simple phrase. Save the houses, not the companies. That is the unwavering government mandate, according to all the analysis.
So it's about social stability.
It's all about social stability. They have to make sure the millions of people who already paid for their homes actually get a finished apartment. Protecting international bondholders. That is way, way down the list of priorities.
You can see that in how their bailout programs, like the whitelist, are structured.
Exactly. The rules for that money are incredibly strict. The funds can only be used to finish specific individual construction projects.
To pay for concrete and workers.
Right. And the rules explicitly forbid using that money to repay corporate debt. It is not for bondholders. It is not for the banks. It is for finishing the buildings, period.
And meanwhile, the underlying market is still getting worse.
It's not getting better. Housing sales are still showing double-digit declines year over year, and these local government programs to buy up unsold apartments to stabilize prices, they're really underperforming. The local governments just don't have the money to do it on the scale that's needed.
Which brings us to the first major investment insight from this whole situation. It's a total reevaluation of how you look at Chinese assets.
You have to. The insight is this: the end of structural guarantees. That old implicit promise that the government would always step in and prevent a total collapse, it's gone. It's obsolete.
So you have to completely remove that government support premium from your valuation models.
You have to price these assets based on their actual standalone risk, which is very high.
And the second insight is pretty blunt.
It is. Avoid the falling knife. The Vanke situation is the ultimate proof that the fundamentals of this entire industry are collapsing. The analysis is very clear. Steer clear of the developers, their bonds, and any banks that have a lot of exposure to them. We are very likely entering an L-shaped depression for this sector.
An L shape, so a sharp drop and then just flat.
A sharp drop followed by years of stagnation, until the huge oversupply and demographic issues are worked through.
So if the government's focus is on building the homes, what does that mean for an international investor holding a Vanke bond?
It means you are guaranteed to take a massive haircut.
You're going to lose a lot of money.
A lot of money. When the government does finally step in to restructure these companies, they will act as an administrator for the public good, not as a friend to creditors. You should expect to have your debt swapped for nearly worthless equity, or see maturity dates pushed out for decades, or just have the value written down to pennies on the dollar.
And the ripple effects of this go way beyond China's financial markets. This has a huge impact on global commodities.
A massive impact. For 2 decades, China was the world's construction site. That engine has stalled. And that signals long-term, sustained weakness in demand for industrial commodities.
We're talking about things like steel,
copper, iron ore, coking coal, all the building blocks of a modern city. This is going to hit the revenues of the big global mining companies hard. The drop in demand from Chinese construction is just too big to be replaced by other sources quickly.
And finally, there's the wealth effect.
Right. A huge amount of Chinese household wealth was tied up in real estate. As those values fall, people feel poorer and they spend less.
Especially on high-end goods.
Especially on luxury. So global luxury brands that depend on the Chinese consumer are going to feel that pressure on their sales.
So the big lesson here is just deep pessimism on the Chinese property sector. The pivot for investors is to move capital to sectors where the government support is actually clear and strong.
Things like advanced manufacturing, technologies that are key to national security, or essential domestic consumer goods.
Yeah.
You move away from the debt-fueled, oversupplied property sector and toward the country's strategic priorities.
Okay, for our final pivot, let's move to the much more dynamic world of AI. The market has pretty clearly finished Act 1, which was that mad scramble to buy up every chip you could find.
The great infrastructure build-out.
Exactly. And now we're moving into Act 2, and this act is all about profitability, applications, and diversifying the hardware.
Let's start with that hardware piece, because there's been this narrative of a war between different types of chips.
Right, the supposed rivalry between Google's TPUs and NVIDIA's GPUs.
And Google just made a big statement. They announced they trained their newest model, Gemini 3.0, entirely on their own in-house tensor processing units, their TPUs.
Which on the surface sounds like a declaration of independence from NVIDIA.
It does. But then almost the very next day, NVIDIA had their earnings call.
And what happened?
They confirmed that big tech, and yes, this includes Google, is still placing massive, record-breaking orders for NVIDIA's high-end GPUs, the H100 and the new Blackwell chips.
Okay, hold on. If Google is building its own chips and using them for its biggest projects, why are they also buying record numbers of chips from their biggest competitor?
Because the market now sees them as complementary goods, not direct competitors. It's all about the economics.
How so?
Google uses its own TPUs for its internal research, for training its own huge foundational models. It's a massive cost saver for them.
Okay, that makes sense. Use your own stuff to save money.
But they use NVIDIA's GPUs for their external cloud business, the Google Cloud Platform, because their paying customers are all building on NVIDIA's platform. So to maximize revenue from outside clients, they need to offer the market standard.
So it's a dual strategy. Use your own chips to control costs internally and use the dominant market chip to generate revenue externally.
It's a profit-optimized two-track system.
Yeah.
And it signals a really important shift for investors.
The great pivot.
Exactly. Act 1, the infrastructure phase, is starting to cool off, at least in terms of stock valuation. Chip makers like NVIDIA and AMD are still posting amazing earnings.
But their stocks are kind of trading sideways. They're not soaring like they were. Why is that?
It's valuation. The market has already priced in so much future growth that it's become very hard for the stocks to move higher, even on good news. There's an intense ceiling there for now.
Which means the big money is looking for its next target.
It is. And the focus is shifting decisively from the companies making the AI, the chip makers, to the companies making money with the AI, the application layer. The market is now hunting for proven, tangible cash flow.
And the early winners here seem to be the B2B software companies.
Absolutely. The firms that have successfully embedded AI into their products to offer real concrete value. The analysis highlights names like Salesforce, ServiceNow, Palantir. Their stocks are hitting new highs, specifically because of AI features that automate tasks or provide better analytics.
And the ultimate proof, the validation for this entire multi-trillion-dollar investment thesis comes from the cash flow numbers from a company like OpenAI.
The numbers are just stunning. The analysis points to OpenAI's revenue jumping from about $200 million in 2023 to an estimated $13 billion by 2025.
$13 billion with a B.
In 2 years. I mean, that's a 65-fold increase. It's just unprecedented. And what it proves is that AI isn't just a science project or a bottomless expense. It is a verifiable, massive cash-generating machine. It validates the entire investment in the underlying hardware.
And digging into that data, there was a fascinating geographical point. Korea is listed as the #2 revenue contributor for OpenAI globally. Why is that so important for investors to know?
It's a huge tell. It signals an extreme level of adoption, both by consumers and businesses, and more importantly, a willingness to pay for AI services.
So Korea is like a leading indicator.
It's a crucial global testbed. It shows you which AI applications are actually valuable and sticky. If it works in Korea, it can likely work in other advanced markets. It's a key data point.
Okay, so for someone looking to invest in AI's Act 2, what are the key takeaways? It seems like insight number 1 has to be about diversifying your hardware bets.
You have to move past the idea that only NVIDIA can go up. Big tech is pouring money into developing their own custom chips, ASICs, to cut costs and reduce their reliance on expensive general-purpose GPUs.
Let's quickly define an ASIC, application-specific integrated circuit.
Right. It's a chip designed to do one thing and one thing only, but to do it incredibly well. It's much faster and more energy efficient for that specific task than a general-purpose chip.
So this trend benefits a different set of companies.
It does. It benefits the companies that help design and build the infrastructure around these custom chips, firms like Broadcom and Marvell. So investors need to diversify from just general-purpose GPUs to the custom ASIC enablers.
Okay, and insight number 2 is all about the application layer. It's the search for what you call pricing power.
This is the holy grail right now. The market is rewarding companies that can use AI features to justify raising their prices.
So it's not just a cool new feature, it's a feature that customers are willing to pay more for.
Exactly. Look at the examples. Adobe bakes AI into its Creative Suite and can charge more for those tiers. Microsoft's Copilot is embedded into the software millions of businesses already use, and it's an extra monthly fee. Salesforce is doing the same. They're successfully turning AI R&D into higher recurring revenue.
And finally, based on that adoption data, it seems like we should reevaluate the Korean market.
For sure. That high willingness to pay for AI services suggests a huge potential for the domestic platform companies there. Naver, Kakao, and the big IT service providers like Samsung SDS and LG CNS.
Because they're best positioned to tailor services for that highly receptive local market.
They know the language, they know the culture, they know the business needs. They are primed to monetize that user base very quickly. It's a really interesting opportunity outside the US.
So to sum up this third part, the AI market is past the "is it a bubble" debate. We are now firmly in the earnings verification stage.
It's all about the cash flow. The analysis suggests a balanced portfolio is key. You still want some of that specialized hardware infrastructure exposure, but you need a strong focus on the software application companies that can prove they are generating real scalable cash.
All right, that was a lot of ground to cover.
It was. But to synthesize it all, I think three big lessons really emerge from looking at these global bottlenecks.
Go for it.
First, the energy cliff is real. It's here. And energy scarcity is now the primary choke point for AI growth. Physical infrastructure can and will limit digital ambition.
Second, that old assumption of unlimited state support, it's broken. The Vanke crisis in China is definitive proof that investors have to fundamentally rethink risks in centrally guided economies, especially when priorities shift to social stability over profit.
And third, the AI market has grown up. The profit engine is now all about applications and massive verifiable cash flow. That's what's redefining the leaders in the tech sector.
And for you, the listener, recognizing these shifts, the energy crunch, the trust collapse in China, the AI pivot to cash flow, that's the shortcut to being well-informed and well-positioned in a world that is changing incredibly fast.
But let's leave you with one last thing to think about. A provocative thought.
I like it.
We've spent all this time talking about the massive energy demand of these large language models. Given the extreme energy scarcity and the political fights over power we just discussed, do you think the next generation of LLMs will be designed from the ground up with energy efficiency as their #1 goal?
So not just about being the biggest or the smartest model, but being the most efficient.
Exactly. If you can create a model that's just as good but uses half the electricity, that shift in design could completely upend the competitive landscape we just spent the last hour talking about. It could redefine everything.
Don't forget to subscribe and hit that like button.